What's up, YouTube? Eric here. Big week of earnings. This is what they call the Super Bowl of earnings. We had a couple of huge earnings reports tonight, Microsoft and Google. I'll cover those in a little bit more detail. Overall, the market today was pretty good. Nice little green day after a few red days. You can see most stocks here are green, especially those mega cap tech stocks. Several of those reporting tonight and this week. We've got Amazon on Thursday. So the headline is Dow closes 200 points higher to end 4-day losing streak as strong earnings lifts stocks. So earlier this week, last week, we had some earnings reports, a little bit mixed results. The earnings today, this morning especially, were pretty good. Now, Google's actually down about 4%, and Microsoft is up about 4% at the time of this video, and earnings just came out about 5 minutes ago. So the Dow closed up 0.62% today. The S&P is up 0.73% to finish the session, and then NASDAQ was up about 1% at 0.93%. So this morning, we had Coca-Cola earnings, a beat on the top and bottom lines. We also had General Motors that was down slightly, and then Alphabet and Microsoft here I'm going to talk about. So a quick primer here, quote, no matter what results we see from big tech earnings this week, so we just had Microsoft and Google, we're also going to have Meta, and we're going to have Amazon, the results won't justify their outlandish valuations. Even with the declines in big tech stock prices over the past 3 months, big tech stocks are still too expensive and are priced for perfection and then some. And that's a dynamic that is not likely to end well. So around 150 of the S&P 500 companies, 150 are slated to report earnings this week. So far, we're off to a pretty solid start. So 23% of S&P 500 companies have already reported earnings, and 77% have posted earnings surpassing analysts' expectations. So let's start with Google. I know a lot of you probably own Google and Microsoft. Now, these are what I call core positions in my $1.5 million portfolio. I've owned these stocks for many years. I've done well with these names. These were, if you look at back in January, we did a top 10 AI stocks to buy for the next decade. And of course, both of these names were on that video. It's tough because those stocks have bounced significantly from those lows that we saw late last year, early 2023. I remember at one point, Google was down, in the 80s and nobody wanted to touch it. And then close to $135, $140 or something like that today. We'll look at a chart here later. So earnings per share, $1.55 per share versus $1.45. So that's a beat by 10 cents. Revenue was also a beat, $76.69 billion versus $75.97 billion expected. So what's the problem? Why is the stock down? Part of it's probably because the stock is expensive. It's rallied significantly, like I mentioned, this year so far. But there's one key thing here that we need to talk about, we'll get to. So YouTube advertising, that was a positive, $7.95 billion versus $7.81 billion. This is the key. Google Cloud revenue, $8.41 billion versus $8.64 billion. That's a miss. And the traffic acquisition costs, $12.64 billion versus $12.63 billion, according to Street Account. So Google's down and Microsoft's up. What's going on? Microsoft profit pops 27% as Azure growth accelerates. So Microsoft is saving the day because if both Google and Microsoft missed on cloud, you would probably see a significant sell-off in tech names. Generally, the public cloud services, the big cap tech companies, you think of AWS, you think of Google Cloud Platform, Microsoft Azure. If those numbers come in light, historically here, we've seen a sell-off in technology. So let's see if we can make sense of why Microsoft is up on cloud and Google is down. So Microsoft was up as much as 5% in extended trading. Beat on top and bottom lines, earnings $2.99 per share versus $2.65. Revenue $56.52 billion compared to $54.5 billion, so a nice beat there. So revenue grew 13% year over year in the quarter. Net income, $22.29 billion, increased 27%. So 13% growth isn't terrible for a huge $1 trillion plus mega cap tech company. But like we talk about all the time, with growth, you have really three different types of growth. You've got hyper growth, you've got what I call regular growth, and we've got mature growth. And Microsoft technically pays a dividend. It's more of a DGIF, but if you're just going to classify it in growth, it would be more of mature growth. It really fits in that DGIF bucket because it pays that dividend. Google, of course, doesn't pay a dividend. That's what I also would call mature growth. So Microsoft's Intelligent Cloud segment produced $24.26 billion in revenue. That's up 19% and above that 23 23.49 billion consensus. And that unit comprises of Azure Public Cloud, SQL Server, Windows Server, Visual Studio, and more. So revenue just from Azure, you take just Azure, jumped 29% during the quarter, faster than the 26% consensus, so 3% beat over consensus. Now, Microsoft doesn't disclose Azure revenue in dollars. At constant currency, Azure revenue rose 28%, accelerating from 27%. Microsoft, of course, during the quarter introduced new, fresh cybersecurity services, announced new Service PCs, and said it would sell its Microsoft 365 Copilot AI as add-ons to enterprises. And that's part of the reason why the stock has run into earnings. And of course, if you were under a rock over the last month or so, earlier this month, Microsoft completed its acquisition of Activision, $68.7 billion. And so far this year, Microsoft is up 38%, while the S&P is up 11% in the same period. And of course, these mega cap tech stocks, they're huge components of these indexes, not only the S&P, but of course, even more so in the QQQ, the NASDAQ 100. So both Microsoft and Google are going to have earnings calls that I'm going to listen to later. I wanted to give you this as soon as I could. And earnings calls can always make the stock move one direction depending on what's said on the call. So looking at Alphabet Google, that revenue is a beat by 980 million. And just so you have an idea of the growth, 11.1%. So again, that's more mature growth. It's not hyper growth. It's not 11% growth isn't bad, but it's what I would call mature growth. And with something like Alphabet Google, I could see it kind of metamorphosizing into a DGIF. In other words, paying a dividend here in the next several years. Now, one thing important to note here, Alphabet Google does not provide guidance. Microsoft will provide forward-looking guidance in connection with its quarterly earnings during the earnings call. And of course, if that guidance light, you could see the stock go the other direction. So Microsoft returned $9.1 billion to shareholders during the period in the form of buybacks and dividends. That's a pretty decent number. Of course, $1 trillion plus market cap, $9.1 billion doesn't seem like that much money when you look at the market cap. Right now, Microsoft is up about 4% after hours at 344. Market cap is $2.46 trillion. So basically $2.5 trillion here after hours. The PE ratio, just looking here quick on Google, this is a 12 months trailing, is a 34.13. Dividend yield is less than 1% at 0.91%. Now, Alphabet Google, I'm looking at A shares, that's GOOGL. You can also buy C shares, just get rid of the L, GOOG. I prefer the A shares. There's not much difference. It's voting rights. If you don't have a huge portfolio, it doesn't matter that much. I always just prefer the A shares. So looking at Google, GOOGL, A shares, $1.76 trillion market cap. That's before it's down 5.27%. So after hours, it's hanging in there at 131.50 right now. The PE ratio on Google Alphabet is 30.39. And year to date, Alphabet's up 55.76%, now about 50% after hours. Microsoft is up 37.96% plus another 3-4% after hours, so it's up about 40%. So if you look at year to date performance between Google and Microsoft, Google is at about 50%, Microsoft's about 40%. So next I'm going to look at a chart for both stocks and tell you where I think they could go and if I think they're buys or not at these levels. Of course, I like both of these names much lower. When you look at earlier this year and late last year, if you're in Patreon Discord, we talked about buying those tier one stocks, the high quality names, the highest conviction names when the market the market's tanking. And so most people in Patreon Discord, if they were buying those names, they were buying them at much lower levels. So it is tricky here. Now I want to point out one thing. Let's discuss cloud. Why is Microsoft Azure up and Google Cloud Platform down? Microsoft is beating expectations and Google is missing. It really comes down, it's as simple as this. When you really look at it, Amazon Web Services and Microsoft Azure, they really dominate the space. They're much larger than Google Cloud. Google Cloud has been trying to play catch up, and really Amazon Web Services is still the king. Microsoft is doing a great job in second place and has been, gaining market share. And Google's been doing well, but it's still well behind those other two names. So if you don't know my background, I used to sell cloud services. I used to work in the software industry for over a decade. In some businesses, Google Cloud Platform is a good fit. But for most enterprises, honestly, Amazon Web Services is going to be the simplest to work with. Azure a close second. And it's really hard, I think, for Google to compete against those other names. Now, I'm not hating on Google at all. I'm a shareholder of Alphabet Google. I have been for a while. I think my cost base is somewhere around $50 on the stock. And I have friends that work at all three. I've got friends that work for Amazon Web Services, for Microsoft Azure, and for Google Cloud Platform. All three of these names are going to continue to grow over time. But from my experience and from the people I know, it's Microsoft. But from my experience and from the people I know, it's going to be Amazon Web Services and Microsoft Azure. Those are really the lead dogs. And Amazon Web Services still is the king of cloud, although Microsoft, like I said, has been doing a good job of trying to gain some of that market share. Now, we're going to see Amazon's earnings here on Thursday, and it's going to be important for AWS to beat on their numbers. If AWS misses, you could see some volatility in the market. And earlier in the intro, I gave you a quote about how these mega cap tech stocks are so expensive. Part of it, of course, is the AI buzz, and that's been a big driver of why these names have, ripped so hard this year. Another part just comes down to the balance sheets. And if you look at these companies, it's a lot safer for investors to trust these larger cap names. They're not going to go out of business. They've got strong balance sheets, strong profitability, cash flows, and so on. And so a lot of investors are going to pile into those names. If they don't want to go with a 5%, treasury yield on a bond, they might go into a name like an Apple or Microsoft or Google, etc. So next, let's look at charts for both Alphabet and Microsoft. Before I do that, guys, if you're new here, subscribe to the channel, click that bell for notifications. And if this video is helpful, drop me a like and drop me a comment. Now, we do something that we call Chart Day every single Wednesday at 9 o'clock a.m. Eastern in Patreon Discord. When you see orange, that's commentary from a previous chart day or from a YouTube video. Yellow is going to be today's information. If you want to join us live, we do live streams every Monday, Wednesday, and Friday at 9 a.m. Eastern, and those are recorded. Monday and Friday are going to be audio podcasts. Wednesdays are going to be videos. They're live stream videos. That's Chart Day. So as I mentioned earlier, Alphabet does not guide. We know that earnings weren't too bad. I think it really comes down to the stock price being a little bit elevated and the fact that maybe they missed on Google Cloud Platform on their cloud. That is one of the growth drivers, and it's one of the reasons why people invest in the stock. So when that misses, it can cause investors to sell off a little bit, sell the stock. So looking at a chart, you can see this goes back to January of 2023. So earlier this year is $85, and nobody wanted to touch it at $85. At least it seemed that way. And I guess that's maybe a little bit deceiving because there was a double bottom here. I mean, back in November, it was $83. It ripped up to $100, so you got a 20% gain. Gave it all back basically by the beginning of 2023. And then it bounced off just under $85, and you can see where it's gone from there. And it's been pretty jagged. It wasn't a straight line, but this is an aggressive trend upwards here from $85 up to $139.16. And then you can see it topped off about $140. So really 140 got some pretty strong resistance. And we had that red line actually drawn up saying that we'd probably get some resistance around that 140. Right now, post-market, it's $133. So it's trading just above the support. It has broken the 50-day. The yellow line here is the 50-day simple moving average. This red line is going to be the 100-day. This purple is the 200-day. So your S3 is down here. You've got about $120.47. This 200-day moving average is about $116 here, just for reference. Your S2 is roughly $125, and your S1 is about $127, and that's going to be below the 100-day moving average. 100-day moving average is closer to about $129. So I think it's quite possible that you could see it break $129. You could see it come somewhere down where these three blue lines are. And of course, the stock could bottom any time. It really has to do with the overall market. If the overall market tanks, this is going to go lower, and you could see it come down to these lower levels. If the market holds up and it starts to rip, you're going to see this name get bought up. It's a big part of the indexes. It's going to get bought up and it's going to find a floor faster. So I like Alphabet Google stock. I'm long. I didn't like it at all. We talked about it on Chart Day not so long ago. I said, 135, 140, I wouldn't pay that for it. Honestly, if it came back to say 125 or less, maybe it's a DCA area. But if you really like the stock, you probably bought it lower. You probably bought it when it was under $100 a share. If you missed it, or if you're a new investor, I think you have to watch these levels. 125 or less is a possible area. I still think it's maybe a little bit expensive. I don't really see it going much lower than $15 a share. I'm not saying it's going to happen. I'm saying it's a possibility if the market breaks down. And that S3 support's about $120, so keep that in mind. But if this stock did break down and got to 125 or less between say 115, 125, that's probably a decent area to DCA, and you might not see that level. Microsoft, pretty similar deal. So back in November of 2022, it got down to $213. It bounced up nicely to 265 or so, and then gave most of that back around 219 here, early 2023, January. And it's basically ripped from 219. It got all the way to 366. This was back in July. Fell from 366 to about 311, and then bounced from 311 to 340, and then back to 309. So 219, 366, 311, 340, 309, and then back up here, kind of topped off about $335 or so. And now it's kind of back in that area here after hours. So this is forming one of those sideways bull flags. That bull flags, I generally like to have that pull a little bit straighter. So I like to see, and just to draw it up so you know what I'm talking about, it's going to be messy freehand with my mouse, but I like to see that bull flag have that pull straight up like that, and then kind of a pennant. But if you look at this, it is kind of sideways. Technically still could be a bull flag, could go higher. So this has $316 support. On the upside, I think you could see 350 plus as a possibility. That R3 right here is $353, this blue line. So right now, Microsoft is trading at $344 after hours. Is it a buy at $344? I think it's more of a hold. I mean, if you own it, of course, I'm long. I'm bullish on Microsoft long term. If you don't own the stock, it's going to be a tough one to get an entry price at this point. Same kind of deal as Google. The chart looks very similar. You had a lot of opportunity to buy this stock, quite a bit lower here if you were buying it late last year, early 2023. And it definitely has a higher floor. I don't think you're going to see these prices anytime soon unless we go into recession or something like that. So I think you have to be careful here. I think it is bullish. If you look at the technicals, I think it's probably going to go higher. I think 350 plus. Would I be a buyer here? Me personally, it's more of a hold. In fact, both these stocks, I think they're great long-term investments, especially if you classify them DGIF and mature growth. So these are not hyper growth stocks. High quality balance sheets. They're going to give you decent returns, but it's not going to be where you're going to get 10x returns off Microsoft and Google when they're 2.5 and $1.5 trillion valuations. So these are great core positions I've owned for years. If you don't own them, I think you have to watch them closely. Google could present an opportunity if it sells off more. Microsoft, as of right now, it could go the other direction if something happens on the earnings call, or if the market breaks down the next couple of days. You got one trending up and one trending down. If I were to buy one of the stocks, I would look more at Google, especially if it comes down a little bit lower, like 125 or less. Microsoft, I think you probably just have to hold, wait for a better opportunity, which may or may not come. Neither of these stocks are cheap. If you look at Seeking Alpha here, the PE non-gap TTM, 33.57 on Microsoft. That gap, the PE gap TTM, 34. If you look at the forward, 29.87. So even that forward gap PE ratio, you're looking at about a 30. And recently we did a masterclass video. We talked about, is Microsoft a buy at these levels or not? And, you have to be able to justify, do I want to pay this premium for this stock? Growth, it's, not a hyper growth stock. You're looking at 6 to 12%. I think we saw 13%, but here we're showing 6 and 10.59%. But strong balance sheet, strong profitability. This is A plus with profitability. Gross profit margin 68% and so on. This is why it's so fashionable, especially with AI behind it. And Google is going to get a D on the valuation here on Seeking Alpha. This is going to be a 28.92. This is PE non-GAAP. And then the PE gap TTM is going to be, so the 12 months trailing is 28.91, and that forward is a 24.18. So Alphabet Google is more attractive even at these prices. It doesn't pay a dividend, of course. And if you look at the growth, it's about the same, give or take. Profitability, also A+, not quite as strong as Microsoft, but still showing gross profit margin TTM of 55.59%. So both of these are strong companies. I think that they're holds if you own them already. And I hope this video is helpful, guys. If you're new, please subscribe to the channel. Click that bell for notifications. Drop me a like, drop me a comment. Have a great rest of your day. Take care.